Oh, great. Thank you for that introduction. It's really lovely to be here today. I'm very grateful to the GPN network, Professor Ramziai and colleagues at Castle for this opportunity. It's been a very disrupted guest professorship. And thanks to Zoom, I've been able to salvage some of the privileges, and this includes this talk. I'm very happy that I'm able to join you today, and hopefully, we'll have a good discussion at the end of it. So today my discussion, as you know, is on inclusion and particularly in the context of global partnerships. So I'm particularly interested in digital financial inclusion, which is quite closely connected to something I've done quite a bit of research on already, which is inclusive finance. And inclusive finance, as we know, has become quite a mainstream development strategy, and it's quite well known. I think that the partnership structure has played a very huge role in this, particularly with support from the World Bank, financial institutions, and so on. With the digital financial inclusion, the needs of a partnership are slightly different, and I'd like to explore those today over the talk, and particularly to explain why these needs are different and what sort of partnerships are being considered or being endorsed and put together right now, what sort of infrastructure they entail. So I will start with an introduction of partnerships. I'll speak also about inclusive finance to give you a little background about how this connects with the broader picture. And then I will talk about fintech. My work is primarily in South Asia. So today I'll be using examples from India and Pakistan to explain these connections between fintech, inclusive finance, and global partnerships. So let's begin with the question of why we're interested in partnerships and more importantly, what a global agenda is and how this connects to partnerships. Now, the starting point for this quite obviously is the SDGs and goal 17, which focuses on partnerships for the goals. Now, the UN sees a successful development agenda. Sorry, I'm a bit stuck over here. Apologies, my slide is not moving. But yeah, I think this should work. A successful sustainable development agenda as requiring partnerships between governments, the private sector, and civil society. These are built upon principles and values and a shared vision and shared goals that focus on people and the planet. And they operate at the global, regional, national, and also local level. Now, more specifically, there are a number of targets in the SDGs, as you know, and there are 30 goals, and there are 17 goals, and each of them has their own set of targets. Now, the ones that I'm particularly interested are 17.3, which seeks to mobilize financial resources for developing countries, and we've seen that kick off quite a bit in strategies like impact investing, social investment bonds, so on, blended finance. The other target that's interesting is 17.5 to invest in least developed countries. So you can see how the connections are quite um, natural over here between mobilizing the private sector and targeting least developed countries as the destination for this sort of capital. Now, this can include, of course, projects that are philanthropic, that have a purely altruistic objective, but it also includes targets such as a double bottom line or even a triple bottom line, so that seek to have financial profitability as well as environmental or social goals. The other target that's interesting is 17.6, knowledge sharing and cooperation for access to science, technology, and innovation. And that's sort of what we are speaking about today. And the fourth target, which isn't part of goal 17, it's part of goal 16, but it's 16.9, is to provide universal legal identity. So I'm going to discuss how this specific target connects to um, an approach which builds on partnerships. Now, some background over here again, and let's begin by talking about something called the FPD, or the Finance Philanthropy Development Complex. Now, this is, of course, a sort of partnership, or rather a term used to describe types of partnerships. But what's concerning, or or rather stands out, is that philanthropy is increasingly guided by financial motives, financial markets, financial actors and financial institutions. Now, what are the implications for development over here? We also know that there is quite a well entrenched FFD agenda, that's finance for development, and that has since 2003. We use 2003 as the turning point over here because that's when the Monterey Consensus was adopted. And since then, the FFD agenda has sought to finance development through private sector support. So the private sector has, for quite a long time now, had a very active role to play in development. So the FPD complex, which incorporates a global agenda, is a collaborative approach to advancing digital financial inclusion. And we're going to see exactly how. We know already that the FPD agenda has been mobilized for inclusive finance, but what changes or what sort of shifts can we see when we talk about digital financial inclusion and not just regular financial inclusion? Now, the digital form of financial inclusion is of course closely related to earlier development interventions, and these are centered on microcredit. And microcredit has a number of names. It's evolved over the years. So there's microfinance, that's its more expansive version. And these earlier interventions were initially grassroots initiatives to counter the exclusionary nature of national financial system. So if you look at, one of the most popular books, I'd say, is Dr. Muhammad Yunus's Banker to the Poor. And in that, you can get the sense of how a grassroots initiative eventually sort of evolved and became mainstream and became something that was adopted by the formal financial system. Now, to explain how inclusive finance has sort of evolved, I've created a graph over here, and hopefully you can see it quite clearly. It's normally small if I'm presenting it on a screen, but you can see that there have been some paradigm shifts around financial access. So whereas we start with microcredit, which is quite a simple concept, it's providing credit to micro enterprises, and a micro enterprise could be, a woman making baskets, it could be someone selling fruit from a street stall, and so on. And microcredit was a means to get enterprises and individuals like this out of debt, and not leave them as victims of informal money lenders. And then you see this evolution take place where microcredit is replaced by the concept of microfinance, and that seeks to provide all financial services. So that includes insurance, it includes payments, it includes savings, and so on. And then you have this shift to financial inclusion, and they're all very, very closely related, but these shifts are important because they tell you of the role of the institutions, the shifting role rather of the institutions that are guiding them. And you see that financial inclusion is it's quite a broad term. It can mean a lot of things. And importantly for us, it also means technology. So financial inclusion came to be used when technology became an important part of the whole narrative of inclusion. And then finally, you have inclusive finance. Perhaps you can extend this now to the current time. Maybe this was relevant 3 or 4 years ago, but fintech has become a very huge part now. In any case, inclusive finance is quite useful for encompassing fintech as well, and most of these strategies, issues, responses are still relevant today. The main purpose over here is that we're focusing on the enhanced use and development of new technologies and also strategies to induce investments in technology to broaden the reach of financial access and what financial access can do in a strategy of development. Now, inclusive finance it's a very mainstream development strategy, and it's come to be mainstream primarily because of one very influential organization, and that is known as CGAP or CGAP, also Consultative Group to Assist the Poor. Now, for those familiar with it, know that it's a subsidiary organization of the World Bank. It was set up and headquartered in the World Bank, but it uses this partnership model where a number of very prominent institutions have joined together to support the objectives of the CGAP. And this is an excellent example of how the FPD or the Finance Philanthropy Development Complex is exemplified. Strategies such as impact investing are also very closely integrated with the broader goals of CGAP. So there are quite a few numbers floating around. There are a number of sources that can get you quite useful numbers, but this one's particularly interesting to give you a sense of how large this broad enterprise is. And about 80 billion is assets under management and impact investment a loan. And that's not surprising when you look at the reach of SZABIST. So these are the organizations that collaborate with SZABIST to provide inclusive finance. And you can see there's quite a broad variety over here. So there's the IFC, which is also connected to the World Bank. There are a number of national donor agencies. So that's Germany, of course, that's the US, that's the UK, that's Norway. Then there are smaller initiatives, tech-based, to promote financial access. And then you have philanthropic foundations like the Bill and Melinda Gates Foundation, the Media Network, and so on. And then you have a few of these organizations that take the shape of alliances. So they cover quite a large number of organizations also, and they're quite influential in shaping policy or setting standards for best practice. Now, there's been quite a lot written about inclusive finance, and I think one very common way to theorize it is to talk about it in terms of financialization. So that's quite an obvious connection to make. You can see that in many cases, poor people are being turned into income streams. They're being exploited. There are large chunks of interest revenues being driven by these groups of people and so on. You can also take a shadow banking approach, and that's primarily because inclusive finance is very firmly, it's a disintermediated model of banking. So just some background, the traditional model of banking is intermediation. So there are loans, and the bank takes loans, and then they use those there are deposits, and the loans are created from deposits. So banks take deposits and then they lend those out further, but a disintermediate model flips that. So what winds up happening is that you create investments, and these investments are distributed. So you gather investors, you take their money, and then you lend it out to poor people or organizations that are catering to poor people and so on. And that's your disintermediated model of inclusive finance, which is the dominant model. So there's a shift over here from originate to distribute instead of originate to hold. And this is made possible because there's a huge demand for yield from global investors, what some scholars like to describe as a global supply glut, a global savings glut. Also, new forms of financial access can overcome regulatory restrictions. So banking is, of course, a very highly regulated sector. So as inclusive finance becomes more formal, it becomes more important to regulate it. And we have regulations like Basel, which are quite well known. There's also the regulation set by the Financial Action Task Force against terror finance and money laundering. And those are quite relevant for us. And we'll see that it becomes even more relevant when we talk about digital financial inclusion. Now, this is where I want to shift gears a little bit, and have given you a background of inclusive finance, and we can of course revisit that in the discussion. But this is the part where we talk about the transition from inclusive finance to fintech. Now, fintech has quite a strong role in development. For a lot of people, the most obvious connection is M-Pesa in Kenya, mobile money. But the background of using technology for development goes back a little longer. Now, particularly digital identification technology is the most contemporary form of fintech or financial technology for development. And you can see digital identification technology perhaps as the leading edge. And there's a huge narrative building around the transformative potential of access and connectivity connected to how we can identify ourselves using biometric data and technology. So there are many examples. The older context is, of course, ICT 4D. And some scholars like to talk about ICT 4D 1 versus 2.0. ICT 4D stands for Information and Communication Technology for Development. So the shift from 1.0 to 2.0 has been driven primarily by the exponential growth in personal mobile phones. And some scholars like Heeks talk about how this represents a shift from community-owned devices. So whereas previously you'd have a community-owned television or a phone in the community or a radio, now because everyone has their own mobile phone, there's a huge shift in how development can be done. Now, this is reflected in contemporary strategies for development and poverty reduction. So not only do you have organizations like the World Bank, like the SZABIST and so on, talking about how mobile phones and digital technology can be leveraged, even organizations like the GSMA, for instance, which are primarily mobile phone tech-based regulatory authorities, are are now actively involved in using digital technology, or sort of commenting on how it can be used or what sort of shape it should take. Now, even in the SDGs, the Sustainable Development Goals, this fixation is reflected. So not only are mobile phones described as enablers for all 17 of the SDGs, they're also seen as central to the delivery of the goal. So the use of mobile phones is mentioned very, very often in the SDGs. So this also ties in with our earlier discussion about impact investing and sort of connecting finance and development. So a lot of the newer strategies that are being proposed now combine profitability with social goals. So a double bottom line, they're funded by the public as well as private sector. Now, for critical scholars, mobile money and other applications for payments, credit, savings, and so on represent digital financialization. So you had financialization from inclusive finance, and that comes primarily because inclusive finance is it's shadow banking, and shadow banking is, of course, the driving force of financialization. But how effective is that connection when we talk about fintech? So for some scholars like Jane and Gabor, for instance, digital financialization can be contrasted with analog financialization. So they're both different types of financialization, but they're financialization nevertheless. And the distinction is that digital financialization relies on infrastructure, and this infrastructure harvests citizens' data. So it monetizes data for companies, and also governments can use this data for political surveillance. Now, my focus is on South Asian countries, as we'll see, but it's quite interesting to also think about why South Asian countries are particularly interesting examples for this. And this is primarily because they have a shared colonial background. So I'm talking specifically about India and Pakistan over here. And within the colonial context, this fixation with official identification and registration is quite important. Mahmoud Mamdani, who's a scholar of colonial rule, colonial governance, has described this mode of ruling as define and rule. So I think that's sort of a pun on divide and rule, but define and rule is quite an important facet of colonial governance, as he writes. There's also the fact that India, Pakistan, and also Bangladesh have had quite a few years of experience with microfinance. So the earliest examples of what has become contemporary microfinance can be found in Bangladesh, and this, through collaborations with NGOs and so on, traveled quite quickly within the South Asian region. Also because there was already an infrastructure of informal money lending, which sort of, provided an opportunity for formal institutions to sort of step in and substitute. Now, where does this push from digital financial inclusion come from? So we know where the push for financial inclusion comes from, but can you, make similar assumptions? So we know that the Consultative Group for Action on Poverty had a huge huge role in this shift. But what about digital financial inclusion? So the CGAP, of course, is heavily involved, but how far can they take this? What other sorts of institutions are involved? And we've already seen that the ICT 4D agenda is, it's been around for a number of decades. So we see that that's evolved also. We also see that the FFD agenda has undergone its own shifts to sort of accommodate digital development strategies. And more interestingly is quite a recent initiative, which is called ID4D. So that's identification for development. And it fits in quite neatly with the previous agenda because there's a consensus on three major points. So one is that information and communications technology are key tools for financial access and therefore development. Initiatives need private sector funding. And thirdly, that the lack of digital identification impedes development narratives. Now, this is quite well covered in the literature on refugee assistance, for instance, that because refugees don't have digital identification, it's very hard to assist them or to provide them the sort of welfare that they need, and it's sort of been extrapolated into a broader development strategy and global agenda. So for this reason, I think it's important to consider how digital financial inclusion, or this whole push towards adding a digital element to financial inclusion, is much more than just financialization. Digital financialization is, of course, a useful term, but what else do we need to consider? Now, I mentioned the ID4D initiative, and some background on that is useful too. So you know, as we saw in the earlier slides, that goal 16.9 is to provide legal identity for all, including birth registration. And we also know that identification is a key enabler for many SDG goals and targets. So because of that, it's been quite easy for the World Bank through this ID4D initiative to mobilize the support of large corporate donors, large philanthropic foundations, and so on. There's also quite a lot of data to sort of support this case for digital identity. We know that 1.5 billion persons globally have no form of identification. Most of them live in the global south. Many are migrants and refugees. Now, this number is interesting because it overlaps quite closely with those who are considered financially excluded or unbanked. So that's 1.7 billion, according to the World Bank's financial inclusion database. And that 1.7 billion number is quite, I think it's quite effective, because if you're familiar with the World Bank's financial inclusion database, which is known as Findex, you'll know that pretty much anyone who has done any sort of transaction with the formal banking sector, including receive or send mobile money, is no longer considered unbanked. So 1.7 is quite a low bar for 1.7 billion is quite a low bar for how you measure those who are financially excluded. Now, the use of digital finance is now a very regular theme in the financial access literature. So when you talk about financial access, most of the time you are talking about stuff like M-Pesa, mobile money, similar apps, payments tools, and so on. Aside from the financial aspect of it, digital finance has one more utility too. So there's mobile money, payments, and so on. But the other utility is for G2P, or what's known as government to person payments. So some scholars talk about e-governance or digital welfare or so on. But what we're essentially saying is that with digital finance, there's a role for the government over here also to include their own system of receiving and sending money to citizens. Now, mobile money, of course, doesn't require digital identification to operate. That's primarily, one of the driving factors behind the success of early success of M-Pesa. But now there's increasingly very heavy regulatory pressure to link mobile money with digital identification, because mobile money is considered a form of banking, and for any bank you need to provide some sort of documentation, and mobile money is increasingly sort of coming into that net. And this is happening because of this very influential and interesting organization called the FATF, or the Financial Action Task Force. Now, the Financial Action Task Force is this G7 body. It recommends how KYC, or know your customer, processes should be carried out. So for the Financial Action Task Force, digital identification is a requirement for mobile money transactions for to counter anti-money laundering, AML, or CFT, to counter terrorist finance measures. The background of the Financial Action Task Force is quite interesting. So this was created by the G7 in the 80s to address money laundering, but after 2001, so after 9/11, essentially, it underwent this very rapid transformation, and it became the global money laundering and terrorist financing watchdog. Now, for FATF, financial inclusion and financial integrity, so financial integrity are policies that counter money laundering and terror finance. So they're complementary policy objectives. Enhancing financial activity through financial inclusion, through digital identification, can enhance financial inclusion for the FATF. And this is why the FATF has backed formal financial access, because they've assumed that informal financial transactions impede anti-money laundering and counter-terrorist finance efforts. So on one hand, you have the Financial Action Task Force, which is skeptical about financial access, and is making every effort to include more and more documentation for anyone who wishes to make financial transactions. On the other hand, you have this new organization being set up by the World Bank through this partnership model, which frames digital identification technologies as having transformative potential for poor countries. And the World Bank narrative over here is quite familiar. So global knowledge and expertise, financial instruments, private partnerships, they're salient features of this approach, which seeks to establish digital identification systems for the delivery of basic services to the poor. The ID4D has something called the multi-donor trust fund. So again, like that CGAP figure where you saw that there are a number of partners and donors and so on, the ID4D also has a number of supporting organizations. So that includes the Bill and Melinda Gates Foundation, the Omidyar Network, the Australian government, and so on. So they all offer financial support, but also it's a forum for sort of discussing development strategy and how digital identification can play a role in this. And we see as a result of this, as a result of this push, that a lot of countries have sort of picked up on this quite quickly. Now, the Aadhaar database in India is quite well known. It's the largest biometric database anywhere. Another very large biometric database is Pakistan's database, which is called NADRA, which is an acronym for National Database Registration Authority. And these two databases give us a very interesting picture of how digital identity can be used and what some of the concerns are. So in India, for example, policy measures such as the direct transfer of subsidies to bank accounts and demonetization. And if you remember demonetization, that was when a large number of currency was taken out of circulation to induce people to use the banking system to sort of, it was a pushback on the part of the government against what they saw as an informal economy that was troublesome and responsible for black money, terror finance, money laundering, and so on. So because of events like this, because of support from the government, a lot of people have been pushed into using digital financial services. And what this has meant is that financial and digital identity for many Indians has been completely merged. So to get a bank account, you need an Aadhaar identification card. So it's not voluntary. Everyone needs to have this 12-digit unique identification number. In Pakistan, also this has been used quite often. The database has been deployed to disburse emergency relief measures. So after floods in 2010, between 2010 and 2012, the government undertook this massive initiative to disburse cash transferred, and they had the support of Visa. So everyone got, as you can see over here, an actual Visa card, which you could, you could go to any bank ATM and take your money out, but you had to be registered and so on. And it was quite troublesome. A lot of people were just selling the cards and getting, less money than they'd be entitled to if they could actually use the system. Now, both these databases have been used also for welfare support during the current coronavirus pandemic. So it's been quite controversial because a lot of people have been left out, but it's also been quite effective because these disbursements have reached a large number of people across very difficult geographically challenging spaces. The key issue is that if you don't have a digital identity, you're not able to access welfare. Now for India, and this is really, I think we're getting to the last part of this. So I just want to give an example of some recent events that have happened. For India, the focus of fintech has been on something called the stack model. Now, stack models are used everywhere, but what this means is that you have layers of technology. So at the base, the bottom of the layer, you have the Aadhaar system. So you have this verification system, and you're essentially allowing developers to come in and build apps around this system so that other enterprises, other fintech firms can get connected to the Aadhaar system. So what that means is that if you're operating, say, a food delivery service, and you need to verify, or you need rather to receive money from people's bank accounts. So that connects to the broader system where the bank has already verified the bank account and you're connected to the payments app, or you're a bank or a payments company and you need to verify identity. So you can, through plugging into this stack, you can access APIs that that give you the sort of program that you need specifically. So this is part of what they call a digital ecosystem, and the stack model is at the core of this digital ecosystem. Now the problem with this is that there have been accusations of revolving doors and conflicts of interest. A revolving door refers to when someone from the private sector works for the public sector and then they go back to the public sector, and there are all sorts of conflicts of interests that arise. This has been quite well covered in a paper by someone called Kavita Dattani, which is focuses on the specific problem of Aadhaar, but this seems to be a recurring problem because it's happened in Pakistan also. And even in the UK, for instance, when they tried to create a contact tracing app for coronavirus, a similar discussion happened because of this problem of revolving doors. Who do you outsource the technology to? And when you do outsource this sort of work to private sector firms, how can you ensure that they're not going to use your data in ways where it's not supposed to be used? How can we design partnerships that are transparent? So in India, the focus has been on this organization called iSpirit. Now, this is sort of structured like philanthropic initiative, where very prominent members of the Indian tech industry who describe themselves as volunteers come together to dedicate their time, energy, and expertise towards India's hard problem. But there are issues of how much access individuals and companies actually have, and how what they're essentially doing is lobbying then when they're trying to propose new rules and new guidance. Similar situation happened in Pakistan. Pakistan's stack model is also something under consideration, but it was sort of damaged before it really took off. In 2019, end of 2019, there was quite a lot of fuss about this Google executive they hired to lead this initiative called Digital Pakistan, which is like the Indian stack model, sort of centered around building a digital ecosystem. But within sort of 6 months, she had to leave because of various accusations. And I think there were concerns about her dual nationality, but the key issue was that she and her collaborators had set up this foundation, a philanthropic foundation called Digital Pakistan, to draw in expertise from Pakistanis working in the tech sector across the world. And to sort of get their guidance. And again, there were concerns about how much access and what sort of conflicts of interest this entails. So that is more or less it. I just want to draw your attention to some questions and debates. Firstly, how coherent are contemporary global agenda? So on one hand, you have initiatives like the ID4D, and then you have organizations like the Financial Action Task Force that are actively impeding financial inclusion. So how can you sort of reconcile these? What sort of meeting point is there? Secondly, how relevant is the problem of conflicts of interest, revolving doors to partnerships? Is this something that we need to consider whenever a partnership model is proposed as the best way forward, or the best sort of development strategy? Are there other fields or areas where this is an issue? I have these examples over here, but can we think of anything else that would be relevant over here? And who should be involved in partnerships? Who decides? Normally, we've seen that it's the largest organizations, the most influential, wealthy individuals. But how can this be changed? And is this really the best way forward? So thank you for your attention. I have slides with further reading in my sources. If anyone's interested, I'm happy to share. But look forward to your questions. Thank you.
Okay, thank you, Juvaria, for this wonderful talk. Yeah, I'm sure, although there has been plenty of information to process, there still may be some questions or comments. And for the ensuing debate, I would like to ask people to use the chat function and to post a star or a plus in the chat so that we can realize that you are about to contribute something. So far I don't see anything, which I will, pity. Simon Scheirer, you have a question.
Yes, can you hear me?
Yes.
Okay, great. So first of all, thank you very much, Mrs. Jafri, for this very interesting talk. I would like to ask, since I'm investigating and also writing right now my master thesis on shadow banking, I would like to know a little bit more about this strand that you mentioned briefly in your presentation. And I'm especially interested in how far does the global, let's say it a little bit broad, in how far does global financial capital repeat the mistakes of the past that have led to the financial crisis in 2008? So what do poor people's loans, microcredits, and so on get securitized and distributed through shady networks all around the world and the financial system? And is this maybe also, yeah, leading towards a new bubble?
Thank you. Should I answer that, or should I
Yes.
gather more questions?
You can answer directly.
Okay, great. Yeah, thank you. I think that's really interesting. I don't know about the shady part, so let's I guess let's backtrack a little bit. So when we talk about shadow banking, now that can mean a lot of things. And shadow banking, as the term became popular after the global financial crisis because there was this realization that you can regulate the banks, but there are all these other sorts of institutions doing all sorts of things, and creating systemic risk, threatening to bring the entire system down. So the term hasn't been used much for inclusive finance, but I think it's important to look at how it can be used, or what sort of shifts or realizations have taken place since then, right? So one of them is primarily that sort of around, and I've put this in the reading list, but there is this article called the Microfinance Schism by someone called Jonathan Morduck, and the schism is basically two camps of people. So some people think that microcredit should be this grassroots initiative, and it should be a community-based initiative. So you can get charitable contributions if you want, or so on, but it is possible to sort of mobilize the savings of some poor people and lend those out to other poor people, and so on. And on the other side of the schism, and the advantage of the prior method is that it sort of it keeps it more connected to the people. It's more of a grassroots initiative, and it's more of targeted towards helping them and building community, and so on. And the other side of the argument is that the bigger the better. So by getting outside funding, we can simply disburse more loans. And yes, there are pressures to keep it profitable, and there are more pressures to sort of collect the debt and not write it off, and maybe even involve thugs going to people's houses to make sure that they pay back, so that your NPL, your non-performing loans, don't get too high, and so on. But in the bigger scheme of things, there are more people getting loans, right? And basically that's side one, right? And that's really what's reflected in the success of the CGAP, is that they involve loads of or big organizations in this. So you don't need the microfinance organization to be sort of rooted in the community. It's just set up following the correct regulatory procedure, so it can receive money from outside. So the thing is, there's because there's regulation, there's nothing shady about it. It's quite they're quite established sort of infrastructures for this sort of thing. So if you're interested, you could look at something called an MIV, for instance, a microfinance investment vehicle. And this is again most definitely a shadow banking institution. It's an institution that's been set up, it's registered somewhere. Maybe it's registered in an offshore sort of tax haven, but it's still registered, and it can receive funding from other sources. It can distribute those, and then you have other you know forms of infrastructure. So impact investing is a good one. It's for some people, impact investing took off really because the banks had this young millennial generation that was interested in also earning profits. So they've set up all these funds now, and they're quite interested in targeting causes. And then you have other processes like loan syndication, um, um, as in basically setting up different tiers of loans, and regulating it like that. And again, the CGAP is quite influential because they have these guidelines that organizations can follow. But the other, I think, part of the story is that it's still immensely profitable. So when lending to the poor, it's documented to be quite safe. They always pay back, but you can still charge them quite high rates, and you can keep your investments competitive in that way. But yeah, the shady network part, it sounds shady, I suppose, because at the end of the day, you're making money of poor people, but it's quite well institutionalized, and you have some of the largest organizations. So you'll have Goldman Sachs, you'll have Deutsche Bank, you'll have UBS in Switzerland, all participating in this sort of industry.
Simon, are you content with this answer?
Yes, more than content. Thank you very much.
Okay, wonderful. Okay, then we have Fabian Scholtes.
Good afternoon, Dr. Jafri. Thank you very much. It was very interesting. I'd like to take up one point that you mentioned, I think at the beginning of your presentation. You refer to this define and rule idea or concept. And just when you answered the last question, you also said you can charge them high interest rates. So as one of the drivers of the whole thing, what I would be interested in knowing, because you mentioned at some point in your presentation, from a critical point of view, there's more to financialization than selling data of people who are covered by the system now. I was wondering, what is your impression in the countries that you're familiar with, India, Pakistan, other countries? Is the concept of define and financialize, is this really mostly about define and commercialize, suck people into the market, charge them high rates? And to what extent is there empirically, what is your impression of that? Also something like define and rule. Is the financialization also a means to identify people in order to rule them? Because I think this is one of the suspicion that many critical scholars will probably have when they look at the whole process. They will probably think that to some extent the motivation is not only to charge high rates, but also to control people in the territory, something like that. So, and I don't really want to like discuss this conceptually, but more ask you, what is your impression? What is driving governments in these countries to jump on that train?
Yeah, should I answer that?
Yes, please.
Yeah, thanks. Yeah, I think that's really interesting, and I think that's exactly the sort of question that I'd like to sort of investigate more about, right? So you're right in saying that, theoretically and critically, you can find quite a lot of way to conceptualize this, right? So this is essentially it's like a spatial fix. You've gone ahead and created new income streams from poor people and so on. But I think it is really interesting how governments have jumped on board with this, right? So even like digital financialization, which is Sudeep Jain and Daniela Gabor's concept, it's quite useful for sort of seeing how this has become a pattern. They talk about this concept of surveillance capitalism also, which is from Shoshana Zuboff, which is it's a very heavy book, and there's a lot of description. But one of the more relevant points is that this sort of capitalism through digital technology and through these large firms being able to map our footprints and our movements and so on, is that they're changing our behavior, right? So where it's a type of capitalism where they're not just seeking to get us to buy things, but they're actively shaping like how we buy things or what we do and so on. And I think the government part would link closely to that, because not only can governments sort of watch us more closely, like invade our privacy and know more about us, but they can seek to change our behavior, right? Like everybody talks about this. I don't watch this show called Black Mirror, but there is one episode which everyone knows, I think, quite well, about the social credit system. In I think in this hypothetical place, people also talk about the social credit system in China, right? How you can sort of guide your behavior and so on. And even with coronavirus, when they tried to make apps over here to sort of see where people are going and who they're meeting and so on, there's huge objections to that, and eventually it wasn't done. I suppose that's the sort of the privilege of living in an advanced country. But the point is that the government, when they do stuff like that, they're actively seeking to change your behavior, right? They're seeking to they're hoping that you won't go out and meet people because you're being watched. And for global south governments, I think the incentives are quite similar, right? There is this very active or very large incentive to sort of control people based on their digital movement. So this was I mean, sorry, cut me off if we're running out of time, I think. But in one of the applications, one of the interviews I had in Pakistan, this was very memorable for me. And this is and then this guy was interviewed, and he wrote about this in one of the tech magazines. But it's about how he had this app, and it's an actual app, like you can download it and use it. But when you download the app and you have no prior credit history, or you've never used any kind of financial product, you can still get a loan instantaneously. So they give you a small loan. They'll give you, like, 100 rupee loan, which is as you know, it's not even €1. And depending on how quickly you pay back, you get another loan. But they're also checking your credit rating based on how many contacts you have in your phone, where you're going, so what sort of area are you in, what sort of, what part of town are you frequenting, what how often you switch your phone off, how often do you charge it, is it just you, are you using a phone that's being shared, and so on. So they can capture a lot of data because of that. And you can really sort of not only just know more about people's behaviors, but guide people's behaviors, right? So once you know that you're going to get a bigger loan if you leave your phone charged or on more often, you're going to, the way you use your phone is going to be different. But the define and rule part is, I think, is really, really important and interesting. It's definitely something that I want to look at more, because that's also a very active part of it, right? Because you are defining people, and the interest rate part is important over here, because it's only you've you've created this sort of definition of this hypothetical consumer that's willing to pay this exorbitant interest rate and share all this information with you. And this this act, or this sort of process of seeking out this definition, or seeking out this type of consumer, is purely sort of based on poverty, inequality, and so on. So it's hugely problematic. You're basically just looking for poor people who have no other outlet, and you're able to sort of gather all this data from them, and then maybe by proxy get data of other people who won't maybe onboard onto your app in the same way, or even use your app at all. Is that helpful?
Fabian?
Thank you. Yes, very much.
Okay. Yeah. Yes. Thanks, Juvaria, for also pointing out these interesting analogies, the Black Mirror episode and the social credit system. And also, I'm sure here in Germany, we also think of the Corona app, which is not mandatory but voluntary. But still, there are millions and millions of people who downloaded it, trusting the government's assurances that data security will be provided, and that their data will not be tracked and will not be kept for other purposes than the purely medical ones. So. Yes, we have Janavi Rao as the next person in line.
Thank you. This is really interesting. I joined in slightly late, so maybe I missed something that already addressed this. You mentioned what you call this fixation with official identification and registration in South Asian countries, and that it's a colonial legacy. I'm curious about why you would say that. I mean, I know that the Aadhaar and many things that the Indian government's doing with online regulations and IT is really problematic, but I'm kind of wondering where the colonial aspect comes from.
Yeah, thanks. I mean, I'd love to hear your thoughts also, if it's something that you're investigating. It's I am trying to essentially draw connections between why it's so if you like Aadhaar and Nadra, these are the largest databases, and they're neighboring countries and so on. And the technological infrastructure of these databases is quite different. So they've gone in a completely sort of different way, the way they've sort of designed it, but the purpose remains the same. So I was drawing attention to this. I think the book itself is called Define and Rule, but it's a collection of essays by this scholar called Mahmood Mamdani. And he's also talked about classify and rule, and he's also talked about define and rule. And I think it's colonial in the sense that the whole experience of colonial rule is often discussed in terms of divide and rule. So the history of the subcontinent is that there was sort of relative solidarity between communities and so on. And then at a certain point, after the British started making these classifications, that's when that solidarity was sort of erased, and classifications such as they decide who works, who's going to be part of the army and who's going to be sort of part of the the clerical class and so on. So I think that extends into this very simple idea of having identification, and identification in a document that actually describes you for what you are. It's something that I definitely like to investigate further, but I think it would probably be more relevant to get more anthropological or sociological literature. I don't, from a political economy perspective, I think it's interesting to see how these countries have databases, and those databases are quite extensive. So it's not just your name and your date of birth. There is quite an active effort to sort of define and classify your background, or try to get more information. I haven't actually seen an Aadhaar actual card, so I can't speak for this, but in Pakistan there was this there are regularly active discussions about whether your religion should be on the card. So it is on the card right now, but then even then they like to talk about whether your sect, so you can be, your card might say Muslim, but maybe it should sort of go further and define what sect of Islam you follow, which is quite controversial, and I hope they don't do that. But there are other ways to sort of get the sect, right? So there are other declarations you might have filed in the past, and people feel that should be part of the bigger database. But when you go back to how the definitions of those sects first arose, there's always a colonial element to it. So for most groups living in the subcontinent, whether it's sort of Muslim, Hindu, Sikh, Parsi, so on, you can get the documentation to show how this very classification was sort of imposed by the British. But yeah, that's it.
Okay. Then
can I have a quick follow-up?
Oh yes, please.
Thank you. That was sounds like a very, very plausible explanation. I was thinking more on the terms of maybe these digital identification pathways are kind of legitimizing people's existence in that country, because that's kind of the path on which the Indian government is going. And I thought that's where maybe the colonial aspect came in from. But yeah, thank you.
Okay, thanks, Janavi. Then we have a question by Joseph Manga.
Mute.
Can you hear me now?
Yes.
Okay, thank you. So my question is slightly different from our main focus, but it's related to financial inclusion. I am from Kenya, so I'm familiar with how the mobile banking works. But I want to ask a question on something slightly different from that. I think when we focus on the mobile banking and the mainstream banking sector in terms of how they the initiatives of how to include people within the financial sector, it's basically, like, for me, I think it's taking it from the top to the bottom. But of late, and this is an experience from Kenya, we've had like a kind of the emergence of financial groups, which are started by women at the local level, which primarily is not based on digital identification procedures, because much of their way of operation is based on social capital. They, in terms of love, in terms of trust, basically I'm talking about the Grameen model of banking. So for me, this kind of shows another kind of type of financial inclusion, which I would call like bottom to up, because it started by the women themselves from up. But along the way, they again would want to have like kind of some formal way of keeping their money. So they then now like open bank accounts and also start to begin using the mobile banking system. So my question is, would you consider in your own impression, is this model, can it be called like financial inclusion, if you are to just be broad about it? Is it also another way of financial inclusion?
So I don't know if I mean, you could call it financial inclusion, but then I think you just need to go back to how you define it, right? So, the generally accepted definition now, which is again a, big contribution of CGAP, is what, all those categories that they assign in the FINDEX, the Financial Inclusion Index. And for that, you have to have sort of made, at least one transaction within the last, however many months or so on, with a formal financial institution. So by that definition, unless these groups of women are using the social capital to lend and then sort of put the money they've lent into a bank account, that wouldn't qualify. But even with the Grameen model, there are a lot of critiques of what social capital actually means, right? Because if you have, and there are all these examples of how in Bangladesh, at least, when they started using the joint liability system, right? So where you have a group of people, a group of women very often. So you have 10 women, and then they apply collectively for a loan, and then one person gets the loan, and then when she pays it back, the next person gets a loan, and so on. And so that was sort of, an early approach to financial inclusion. And then they found that when the women weren't paying back the loans, they were absolutely destroyed, because the other women would stop talking to them. They'd stop, helping them out with their kids or their cooking and so on. And they'd, be ostracized from society. So that, that's an example of, sort of a financialization of everyday life, and how it creeps up and creates new forms of exclusion and so on. So I'd be a little generally I'm a little skeptical of when terminology like social capital and so on is used, because it can mean so many things, and it's still capital, right? So it's not it's not money that you put in your wallet, but it's still this capital centric view that you have something and you can sort of use that something as an income stream, right? So that's, to me, it's just marginally different from saying that a lot of women have gold, so let's make a new rule to collateralize the gold, or let's change the prudential regulations. And that this has actually happened in many countries to accommodate livestock or grains and so on as collateral. So yeah, I'm not a huge fan of social capital.
Joseph, are you content with the answering of your question? So, I take it as yes. Paula Hofer has the next question.
Thank you very much. And thank you, Professor Jafri, for the really, really interesting talk. I already enjoyed your class, so I was happy to join you in this as well. I hope I can make my question clear. So what is just jumbling in my head right now is you mentioned how it's problematic that those new financial technologies increase like the potential to change behavior of customers. And I was thinking, well, anyone who's going into financial services, particularly if you're coming from a really poor background, you will maybe get a credit, and that there will be a changing of your behavior, because you will try to, service your credit, and like you will behave in a way that is benefiting to the financial organization that you're lending from. And now with all the fintech coming in and those new mechanisms of control, on the one hand, I sense that, yes, so there's something new as those technologies are new, but on the other hand, I'm thinking, isn't it just more of the same? Because those mechanisms of control, like they're more intense, they go more into the private life maybe, and they're more constant, whereas before maybe the microfinance person would, knock on your door every day, and now you get those messages on your mobile phone. Or maybe that person wouldn't have knocked every day, but every second week. So yeah, I'm thinking, isn't it just an intensification, this digital financialization, more than something actually like changing the principles?
Yeah, thank you. No, I think that's an excellent question. So I've also grappled with this because that's one of the bigger questions I'm interested in, right? That what is the meaning of digital financialization? Is this, is it just more of the same? Is it just a new way to sort of, use people's behaviors and their, their patterns of day-to-day life to extract income streams, or is there more to it? So in that sense, you're absolutely right. There are a lot of similarities. So it is essentially new technologies, coming in and finding new ways to extract it, right? So previously it would be interest rates or very high fees charged for transactions, and now you can actually gather the data and sell it. So these are small changes. They're just ways of sort of mapping the behavior and then looking at how it can be turned into more money. But I think what's really interesting now, and I didn't go into this in the presentation because I wanted to stay a little bit focused, but I think this security and political economy overlap is really interesting, right? So what we've been talking about is quite firmly, it's a very political economy analysis, right? Who benefits, as you'd get from Susan Strange. And you know that over here, there were, previously the financial institutions were benefiting. Like Zimon mentioned, initially there's this sort of shady network, and the financial institutions are now tapping into smaller financial institutions, which are tapping into small lenders and so on. And now you have these large tech companies coming in and sort of jumping into the party and trying to get a piece of it, right? But I think what that analysis misses, and this is where that whole discussion of the Financial Action Task Force is really important, is that there's a very strong security imperative over here. Now, first, for some scholars, this security imperative has, driven a lot of things since 9/11, right? So when you have discussions about other fields of politics, a lot of people take 9/11 as the sort of turning point, and they do their analysis based on what happened after. For political economists of finance, we tend to use the 2007 financial crisis, right? As in what's changed, and we had this huge disaster, nothing's happened. But and this analysis you'll find in feminist political economy, which and feminist political economists have always argued that this separation between security and political economy is kind of artificial, and the patriarchy exerts itself through these two imperatives. And I think now when you have this digital financial inclusion and this huge sort of push for fintech, the security imperative is becoming really, really important over here. So all of these institutions that we've covered, like ID4D, the Financial Action Task Force, and then even the SZABIST, this emphasis on digital identity really covers this this fear of money laundering, terror finance, and so on, how it's really being prioritized and sort of inserted into other global development agenda. So it's not just a development agenda, it's also very much a security agenda when you start reshaping it like this.
Paula, any follow-up, or are you fine?
No, I'm happy. Thank you very much.
Okay. Okay, then we have a second question by Simon.
Okay, thank you very much for giving me a second go. I hope we still have this time. I just have a very brief question following up to a discussion we already also had a little bit in the seminar. I remember we were talking a lot about this narrative of the loanable funds theory of banking, according to which banks can only issue loans out of pre-existing stock of deposits that other people have put into the bank. So this classical intermediary idea of banking that is still prevalent also in mainstream economics. However, as we know from post-Keynesian research and even from central banks, at least in the West, a lot of Western countries, actually banks do create money out of thin air and then just issue the loan against it. And we had some discussion that this is a little bit more difficult in global southern countries. But still, I feel this whole narrative on development finance and inclusive finance, interestingly, this is my question, is this anytime mentioned that there is also the alternative of at least state-owned development banks in countries of the global south to actually create credit out of nothing and distribute it to people as microcredit, for example? Because I feel this loanable funds fallacy is very, very widespread in the entire narrative and discourse that you described here. And I wonder if there is at least sometimes the notion or the mentioning that there is an alternative, namely government-sponsored development finance, which does not rely on channeling funds from the super rich of the world all around the globe into the pockets of the poor, very poor.
Yeah, thanks. I think it's a really fascinating discussion. I don't think it's mainstream at all. So none of the development organizations that we mentioned, the World Bank or IMF or the regional banks also have really sort of touched upon it. I think the one exception which I've come across is this, it's one paper, and it's an UNCTAD paper. So that's the United Nations Commission on Trade and Development. And the discussion over there is about a credit financed expansion. So that's how the authors word it. But they do extensive empirical analysis, and they find that in some cases, countries that have development banks are essentially, creating loans and financing their investment through that. But then when you do the empirical analysis, you find that the link sort of breaks off. It weakens when you have a country with any kind of deficit. So if they have a trade deficit or a current account deficit, then that's a problem, because there are inflationary pressures, and because you have to pay back the currency, you have to pay back your currency in another currency. I mean, you don't pay back your loan in that currency, you pay it off in another currency. There's that fear of depreciation. So I think I don't think it's a mainstream concept at all. I think the bigger discussion is that I mean, there are two ways of looking at it, right? So one way is, as you said, that why do these countries need inclusive finance, and why do they have to come up with all these ways to fund development and seek FFD programs and whatever it's called from billions to trillions, I think, the FFD initiative, from outside sources. Like, why are they dependent on external finance? Why can't they just create it on their own, right? But I think for that, even in the post-Keynesian literature, like if you look at the stages of banking literature, you can come to the conclusion for many countries that they haven't reached that requisite stage of banking. And now with the way banks are sort of regulated and structured and allowed to expand, it looks quite difficult for global South countries to get to that stage. The other part of the discussion, which I think is interesting, is if there are countries, and there are some countries, if you go by MMT, that can just create money, ex nihilo, or just out of nothing whenever they want. So what if these countries came up with a more strategic plan to help out countries that can't? So let's assume that some countries can and some countries can't. There are restrictions on some countries that prevent them, but for other countries, that's not an issue. So, a broader sort of global plan to help these countries. And this kind of discussion actually came up quite a lot just about a year ago, when coronavirus had first started, and everybody was thinking that if the UK and the US are in such deep trouble, what's going to happen to all those poor countries where they don't even have proper healthcare? It turns out things weren't so bad for them for various reasons, which I think are still not fully understood. But there was this whole discussion about how we should write off their loans, but also use our sort of capacity to create, credit without any restraint, to pay off those loans and restructure the economies and, their entire sort of debt profile and so on. So it did come up, but then I think because those countries weren't really in as big trouble as everyone thought they were, it kind of died out. But there are on, walks and Vox.eu and these sort of forums. This was I discussed quite often, but it never really went anywhere. But yeah, thanks.
Thank you a lot.
Yeah, let me put the paper here because I forgot what it was called.
Okay, so before we come to the end, maybe one last question that I would like to pose, and this is a rather general one because I'm not too familiar with the whole area of financial inclusion, but I supervised actually a thesis on microfinance in Bangladesh and its relation to, on the one hand, women's social capital, and on the other hand, disciplinary mechanisms. So basically how women's social capital was sort of exploited as collateral by the microfinance institutions, and which you described already. And here I got the impression, and my question is basically am I going too far here? But it seemed to me that this whole microfinance Mohammed Yunus hype was very much a renewal of the old promise of development that the global capitalist order actually gives to the poor of this world, that basically it is possible to combine profitability with social goals, and that there is no contradiction here and no conflict of interest, and that basically all we have to trust is the magic of the market again. And this becomes especially devious if we actually look at the origin of the financial crisis of 2007, 2008, and you mentioned there was a saving glut. So basically, neoliberalist monetarist policies have led to a huge supply of capital looking for profitable investment, which then led to, on the one hand, the food crisis, the speculation on the food sector, but on the other hand, then it led to the discovery of the bottom of the pyramid as a new profitable market segment, which is then being used here. And yeah, so my question would be that, do you think this is would you say that this is actually too radical and goes too far, or would you say actually this is something that I would subscribe to?
So you're asking if that that analysis can sort of be reconciled, where you have this financial crisis and you have this global savings glut, and you have this need to sort of tap into the bottom of the pyramid.
Yes, basically that we are dealing here with an old story of profitable capital seeking investment, an old promise of development being renewed to provide legitimacy for a hugely unequal global capitalist order, where now the next step is this development finance from billions to trillions agenda, which you described, which can also be explained by, okay, so basically through these decades of neoliberal policies, the public finance is being dried out. So the SDGs officially claim there is no other way. We have to tap private money, and this has to be done through public-private partnerships, which again assume that that profitability and social goals can be combined, that the poor can be helped by investment, and et cetera, et cetera. So which then would lead to a diagnosis which would say, well, this is all, to put it bluntly, this is all an ideological move.
No, absolutely. I totally agree with you. So I think that is, quite a good way of looking at it, right? So once you exhaust all the other sources, you have to look for new ones to exploit. But I think, I mean, that's completely accurate. I don't see any flaw in that sort of analysis or explanation. The sort of other way, or maybe to extend that further, and that goes back to what Zimon just said about this sort of asymmetry in money creation, is that this whole system in which there is a global savings glut, and again, you can take that idea apart also, right? Because the idea of the global savings ladder, if you get into post-Keynesian theory, then doesn't that sort of imply this loanable funds idea, right? That you need savings to create investment, whereas you could just create the investment ex nihilo. So I mean, I think it's a useful explanation, but I think it's also important to have a little disclaimer there. But I think the asymmetry part is also really, really important, right? Because it's not just that these countries are, seen as a source of income or as a source of exploitation, and now that these rich countries have come up with run out of ways to deploy their wealth, they have to find other ways. It's also because the whole nature of the system is skewed towards rich countries, right? So they're able to produce more and more wealth, and when they produce more wealth, that goes into these sources. But why is it that they can produce more wealth? Why is it that that obviously this ties into much bigger arguments about colonial extraction and so on. But even aside from that, even if you just look at the contemporary system and the way we deal with foreign exchange deficits, debt, the problem of what they call original sin, where a poor country or global south country can't borrow in its own currency, and this is why there are these opportunities, right? So if very simply, if you could overcome this problem of original sin, you don't need money from abroad, right? Then you're sort of closer to being able to produce credit and money on your own. But there are these structural factors that that impede them. So yeah, the broader narrative of money flowing from rich countries to poor countries to exploit and to seek out profitable opportunities is totally true. But I think the sort of in between the macro and the micro narrative is the system itself, the structural constraints that have placed us in this situation.
Okay, thank you. So we have 3 minutes left. So in theory, there could be one really, really short question, if there is one. But if it is not the case, then yes, Juvaria, then on behalf of the whole GPN and all the rest of the audience, I would like to thank you a lot for not only wonderfully explaining the matter with your slides and your talk, but also with carefully replying to all these different various questions that were being posed here. So thanks also to those who asked the questions, and yes, we are looking forward to your working paper on the issue. And yeah, we hope to continue the cooperation with you in the GPN here. Thanks a lot.
Oh, yeah, thank you so much. It's been a pleasure, and really great, insightful questions that I think I'm going to draw upon later when I got my notes. So thank you for that.
Okay, thank you. Okay, thanks everyone. Are there any organizational matters that I still should be mentioning, Simona? But okay, this does not seem to be the case. Then I will just say thanks a lot and hope to see you next time again. Bye-bye.
Thank you. Bye.